Hi everyone, good evening and welcome to this year's first installment of Stashaway's Master Your Finances series. So just for everyone who has joined us this evening, welcome, and thank you so much for joining us early if you have waited. Just to give a little bit of background, Master Your Finances is a biannual event, or rather biannual webinar series that we hold where we take people through investing basics and dive deep into certain aspects of managing your finance. We hope that by the end of each series, you'll be equipped with the knowledge to get started on your own investing journey, or if you're already investing, have more confidence to continue on this journey, especially given that most of us here are probably investing to prepare ourselves for long-term goals like retirement. So to start, let me do a very brief introduction of Stashaway for those who may not have heard of us. So we were founded in Singapore in 2016, and we have since expanded to 4 other geographies, including Malaysia, Dubai, Hong Kong, as well as Thailand. So we are licensed in 5 different jurisdictions. As of 2021, we do have $1 billion of assets under management. And some of our backers include Sequoia, Fidelity, SquarePeg, and Hamilton Lane. And we've also received numerous accolades over the years, with 2 of the more recent ones being named as one of APAC's high growth companies by Financial Times and amongst the top 200 global fintech companies by CNBC. So we are a digital first company. So the image you see on the left of 2 mobiles is an actual look of our app. For those of you who are currently not on board with us. And as you can see, we do try to make it as clean and simple for our users. So if you have not already checked this out, please feel free to download the app of any app store and you may be using and play around with the app. So over the years, we have also released a good selection of products, as you can see on your screen. This is what is currently available for our users here in Singapore for cash management all the way to private markets. Our private market offerings are currently only available to accredited investors in Singapore. But in any case, if you'd like to find out more, please do feel free to reach out to our team at support@stashaway.com. Now, this is the agenda for today. We're going to be running through some investing core principles. We're going to kind of have a chat and see what it means to really build a strong foundation. What are some of the best practices you should be holding on to? Oh, apologize for that. What are some of the best practices that you should be holding on to and habits you should be developing in order to ensure that you'll be a successful investor and grow your wealth in a sustainable manner? Now, before I proceed, I do want to share that we're live on 2 platforms. So we are live on Zoom as well as Stashaway's YouTube. So regardless of where you're watching us from, if you have any questions at all, please do feel free to post them on Zoom, the Q&A chat box. If you're on YouTube, please use the chat box on the right. I promise I'll leave time at the end to answer them. My colleagues are also helping in the background, so we will try our best to get through as many questions as possible. Now, to begin, let's first start with what it means to build a strong foundation. So for a start, why do we invest? Now, we invest for different reasons, but the main reason is because we want to grow our wealth and we want to ensure that we are able to achieve financial freedom and retire comfortably when the time comes. Now, investment success isn't primarily about outperforming markets or, maximizing your returns. It's really about achieving what truly matters in your life. Now, goal-based investing represents a very, very crucial paradigm shift in financial planning. It basically aligns your investment decisions with your personal objectives rather than any sort of abstract benchmarks that you may see or set for yourself, right? So this approach brings more clarity and purpose to the financial decisions that you would make, and it helps you prioritize competing needs, manage your risk more effectively, and obviously remain disciplined during market volatility. Now, it's a very practical framework to help with aligning your investment strategy with your life goals through a diversified portfolio. Now, goal-based investing does transform the traditional investment approach by connecting whatever financial decisions that you may be making directly to any sort of personal life objectives that you may have. So rather than, chasing market benchmark or any sort of abstract returns, it provides a framework where each investment serves a very specific purpose. So the purpose could be, for example, your child's education, retirement, perhaps you're saving up to buy your dream home, or any sort of other meaningful life goals that you may have. Now, this approach definitely, for one at least, enhances motivation, because you know that, hey, in 10 years, I do want to send my child to university. It helps you improve your decision making. And obviously, it also allows for more precise risk management that is tailored to each goal's timeline as well as importance. Now, I will run through that in a little bit deeper shortly, but basically with goal-based investing, the result is more intentional. So it makes it a more personalized and meaningful financial strategy that essentially transforms investing from a very purely, transactional financial exercise into an integrated part of your life planning journey. Now, let's see what the key differences between traditional investing and goal-based investing are to make sense of what I'm really talking about. So what you see here on the left is what an individual focused on traditional investing thinks about. How can I beat the market? How do I maximize the returns on my investment? On the right is what goal-based investing would look like to an individual. My child is heading to university in 10 years. How can I actually optimize my investments now to ensure that I'm able to live a comfortable life when I retire? So with goal-based investing, you're more focused on milestones. And as I mentioned earlier on, this basically allows you to be a little bit more level-headed when it comes to investing, and it makes you less susceptible to noise in the market in general. Now, the last few days are actually a great example, right? Markets have not been doing too well. With all the noise and volatility, you would have been tempted to exit altogether and perhaps just hold cash. But if you know that you're investing for the next 10, 20, or 30 years, you would basically stay the course. And markets have statistically 100% of the time recovered from a downturn. So it's also important for you to stay invested. Why is that the case? So I'll also run through that a little bit later in the webinar. Now, why is goal-based investing a good way to invest? Now, many studies have actually shown that goal-based investing is generally way more effective and more likely to help you ride out the market volatility than the constant chase to beat the market. So it creates a psychological alignment between your money and what truly matters in your life. So when investments are essentially directly connected to a specific personal objective, as I mentioned, it could be retirement, it could be a kid's education, it could be buying a dream home, it could even be, I want to travel in the next 6 months. You're more likely to stay committed during market volatility and make consistent contributions through the volatility as well. Now, this emotional connection, to not to get too deep, but it basically transforms a very abstract financial concept into tangible life goals. And this basically significantly enhances both your motivation as well as your discipline. Now, it also helps enable a more precise and appropriate risk management. So each goal has its own time horizon, has its own importance level, meaning, you know which one's a priority today, which one is perhaps, the second in line when it comes to prioritization and funding requirements. So this allows for, you to create a more tailored investment strategy. Short-term goals can be basically funded with more conservative investments, while long-term goals utilize more growth-oriented approaches. So you can potentially invest in riskier assets if you're planning for a goal that's basically should materialize in the next 10 or 20 years. Now, this precision in risk allocation leads to more efficient use of your capital, and then it also can better match your true risk tolerance for each specific life objective. Now, the result is a portfolio structure that naturally evolves with your life stages rather than following, any sort of generic age-based formulas. So what is the best way for us to build goals? So let's run through a strategy that we call the SMART strategy. Now, SMART is an acronym for specific, measurable, achievable, relevant, and time-bound. So I will run through it. I'll run through each letter one by one and give you a couple of examples just so I can help you make sense of what SMART goals actually means. Now, the first thing, specific. So this means that your goals should actually be clear and well-defined. So as an example, instead of just saving money, it can be, the specificity of it can be save 5,000 for a down payment on a house, as an example, right? Next, let's move to M, which is measurable. Now, this means that the goal should have a measurable criteria for tracking any sort of progress. So instead of you basically writing down your goal as reduce debt, the goal would essentially be pay off $10,000 of credit card debt within the next 12 months. As an example, you shouldn't have credit card debt of $10,000, but just as an example, you should definitely put a figure as well as a timeline to it. The next is achievable. So this means that whatever that you have set as your goal needs to be realistic and attainable given your current resource as well as your current circumstance. Now, it's easy to just tell people that, and say that, hey, I will become a millionaire. But remember that the goals also need to be achievable. If that is achievable for you, then by all means, keep that goal. I'm not saying it's not achievable. Otherwise, be realistic and flip it to, hey, I just want to increase my investment amount by 20% every year for me to get to, say, 1 million by the time I'm 60, as an example, right? The next is R, which is relevant. So the goals should really align with your values as well as larger objectives. So this relates to what you would like to prioritize at a specific point in your life. So, if you're currently saving up to buy a property, then perhaps the purchase of a new car, unless it's something that you absolutely need at this point in time, can wait so you can channel your funds toward your property fund. Last but not least, T, which stands for time bound. Goals should ultimately have a very specific time frame for completion. So for example, you may be thinking, okay, I should start saving or I should start investing. However, just saying that would not actually be a very strong call to action for you. Putting a very specific time frame on it would make it more actionable. So for example, open and fund an investment account within the next month. So at least there's a little bit more of a sense of urgency, and you know that, hey, by next month, I definitely want to make sure that I've opened that investment account and I've put my first $1,000 toward investing in the market. Now, let's put all these 5 steps of creating a smart financial goal together. So obviously, the first thing is identify your goal and make sure your goal is specific. Secondly, quantify and measure your goal. Make sure that you have a specific amount to it, a specific value to it, and perhaps a specific timeline to it. The third thing is ensure your goal is realistic based on your current circumstance, based on the capacity that you currently have. Make sure that you're able to also stick. The reason why it has to be realistic is you want to also ensure that you're able to stick to whatever objectives or whatever sort of plan that you have in front of you. The fourth thing is make sure that it's relevant. So align your goals with whatever your current values are. And the fifth is time bound. So set a deadline for you to achieve that goal so that you feel more motivated and you have more of that sense of action in you to basically go out and achieve what you need to achieve. So why is setting SMART goals so important? Basically, it helps with enhancing your focus and clarity, which then allows you to give you a clearer picture of what your motivations are and how you can get to your goal. It will keep you motivated and accountable, which I've mentioned, especially if there is a time-bound element to it, and it allows you to better track your progress, right? So as an example, say in the next 3 months, you want to, pay off a specific debt that you have. If you actually say that, hey, within 3 months, I do want to pay off this debt, or let's make it more positive. Let's say in 3 months, you want to start an investment account and start funding that account. And you tell yourself, okay, in the next 3 months, the 3-month mark is when I want to ensure that I have started an account and I have at least $5,000 in my investment account. So I will start basically investing today, maybe $1,000 or $1,500 every month until I get to that 3-month mark to ensure that I have that $5,000 that I need in my investment account. So now that you have laid out your goals, let's think a little bit more about a strategy. Now, there's a strategy and concept that we wholeheartedly abide and buy and believe in Stashaway, and that is the concept of asset allocation. Now, what does this mean? So this means dividing your money or the funds that you have prepared to invest into different assets to achieve your financial goals, depending on your risk tolerance. So let's put this into action. I know theory is there, but it can be a little bit confusing, and the only way for you to really understand theory is to really see it in action, right? So now that you've established your goals, let's think about determining the right asset mix to help you achieve your goals. So what you see here in this little table are 4 main assets, equities or stocks. So this is essentially you owning a part of a company. It's generally high in risk and can be volatile, but it can also lead to big gains. However, given swings, your losses will also be pretty large, right? Now let's think about bonds. Bonds are you essentially loaning to a government or a corporate, and they in return will pay you back is an interest, basically, or what they call coupon. It's generally much lower in risk compared to equity, so it's generally a lot more stable when it comes to volatility, which means returns are usually fairly moderate. The growth is not as basically the growth is not as intense as equities, and swings are not also as wild as equities. And generally, it does give you a slower and steadier returns. What about commodities? Now, these are essentially exposure to raw materials. So we're talking gold, oil, silver, uranium. So depending on what you're investing in, the risk can be anywhere from medium to high. The growth for these assets vary because they can be cyclical. Lastly, we have cash. So this is what you have in your savings or equivalents. Risk of this is low and can be very stable. But as we all know, growth can also be very slow. I checked my own personal savings account over the weekend. I got an exciting 21 cents. So, you kind of get my drift of where just holding cash can also be, it's not also the most effective, but that's a separate conversation altogether. Now, this is an example of how an asset allocation strategy in a diversified portfolio looks like. I'm using Stashaway's portfolios as an example for you. Now, depending on your risk comfort level, you would have different exposure levels to different assets. So as an example, I'm someone who's willing to take higher risk. I'm more comfortable. I probably have a little bit more experience in investing. So I opted for a high risk portfolio. So if I basically were to opt for high risk portfolios, that means I would have high exposure to risky assets. So in this instance, we're talking about equities or stocks. If you're someone who, say for example, I'm more comfortable or I'm not too comfortable with taking risks, I've just started investing, I'm still trying to understand how markets kind of move. Perhaps you'll be more comfortable with a lower risk portfolio. With a lower risk portfolio, that means you would probably have more exposure to stable assets. In this instance, it could be bonds or stable commodities like gold. Of course, this would mean your returns will also differ, as you can see at the bottom. But ultimately, what we mean to say with asset allocation is that regardless of where you are on the risk spectrum, your portfolio should contain various assets just to make sure that you have a more not just diversified exposure to the market, but also in the event that, say, for example, if let's say equities are extremely volatile at this point in time, at least there's something that's a little bit more stable that can basically help you balance out the volatility in your portfolio. So the swings that you would potentially see in your portfolio when you open, your app in the morning, you will not be actually caught in too much of a downturn for your portfolio. Now, as illustrated, of course, there's more nuance than a straightforward black and white structure when it comes to deciding on your asset mix. Your unique situation would also influence your own portfolio construction. Your risk profile, your risk tolerance and capacity, the time horizon of your goal, is it 5 years, 10 years, 6 months, 1 month, and obviously your liquidity needs. Let me run through each of this in more detail to give you more color. Now, what we talked about, there are two concepts that people often get confused with, right? We talked about risk. There is risk appetite and there is risk tolerance. Now, these two things are very different and often get confused by a lot of people. Now, your risk appetite is someone saying, I am willing to invest in risky assets. Keyword here is willing. Risk tolerance is, I can't accept risk that will cause my portfolio to decline more than 10%. Now, do you see the difference there? There could be an individual who is saying that, hey, I'm willing to go all in on stocks. I am aggressive in nature. I'm willing to bet everything on one particular equity stock. And then tomorrow, unfortunately, when the market opens, because of certain macroeconomic factors, market is not doing too well. And that portfolio kind of tanks, or the portfolio, unfortunately, you see losses of anywhere from maybe 15 to 20%. The individual could feel a little bit uncomfortable, right? So that's why understanding your risk tolerance is a lot more important than your willingness when it comes to risk taking. So as I mentioned, people are usually willing to take higher risks for the promise of higher returns. Sounds great, right? I take a little bit more risk, but I potentially also get more returns. But when market moves against their expectations, they find that they're unable to sleep at night. So make sure that you are taking risks that is within your own comfort level. That's very, 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 very important. I spoke about time horizon as liquidity needs as two factors that's important, and this is why. So here you see two different assets that are of two different risks. So we have bonds as well as equities. As I mentioned, bonds are generally a lot steadier in nature. They are less volatile. Equities or stocks are generally a lot more volatile, right? So this is their movement over a 24-year period, right? Let's use that as an example. Next, you see here, there are two goals, goals A and B. Now, if you see both goals A and B start at the same time, goal A ends a little bit earlier and goal B ends much, much later. So if you had decided to invest in equities for your shorter goal, as an example, goal A, upon when you needed your funds, you would have had to withdraw less than what you have started with, and you may not have enough for the commitment you had made for that goal. Whereas if your goal is longer, like where goal B ends, you can afford to invest in higher risk assets as you would have had more time to go through the market movements, right? So this is why, as I mentioned, your time horizon also plays an important role when deciding on the level of risk you should take when investing, as well as your liquidity needs. So if you know, say in, let's make it a little bit shorter. Let's say in 6 months, you know that, okay, I've already signed a couple of papers. I need to get some funds ready for a property that I've just purchased. Do not invest that sum of money all into risky assets. Make sure to diversify, but potentially even just put it in bonds as an example, just to get steady returns, so that when it comes to 6 month mark, when you actually need the cash, you have your capital and a little bit more. If you know that, okay, right now I am in my 30s, I intend to retire in 30 years, and I know that, historically, I can actually, first of all, I am willing to take risks. I'm comfortable with taking risks. I know that markets generally tend to recover, and I intend to invest for the long haul, right? Set and forget. Then, okay, maybe you can decide to put a bigger exposure into riskier assets because you know that, hey, because of the growth potential of certain equities or certain companies that I'm interested in, there is a potential for me to invest today and in 30 years, hopefully to double or triple, even quadruple my money. So that's why your time horizon as well as liquidity needs are two very, very important things that you should also consider when deciding on the kind of risk that you want to take for your investments. Okay, so as a reminder, if anyone has any questions, if you're in Zoom, please feel free to use the Q&A function button on Zoom. If you're watching us on YouTube, please feel free to use the YouTube chat box. I'll get to the questions at the end. At the same time, I have my colleagues in the background who's helping me with answering any sort of questions you may have. It could be about Stashaways app, it could be about this presentation, it could be about any sort of portfolios that we may have. So please feel free to use the Q&A function button as well as the chat box on YouTube. Now, let me move on to the third thing on the agenda. So let's talk about fees. Now, this is one part of investing that a lot of people don't think too much about. A lot of times we're like, hey, I'm making money, so it doesn't matter how much I pay, right? Wrong. So fees actually play a much larger role than you would think. When you're investing in a mutual fund or a fund or investment product, you are charged a series of fees, as we actually see here. Now, some of this may actually be hidden and not stated in full transparency. So please do ensure that you take into consideration the fees that you are paying. When you're in conversation with someone who's trying to basically onboard you into an investment product, ask as much questions as possible regarding costs. These are things that they should also tell you. And then from there, at least you're able to make an informed decision. So here are why fees are important. Let's use this example. So we have two, different platforms. And you basically decide that you're going to invest on these two different platforms, and you're basically for the next 30 years on a monthly basis, you decided to set aside 2,000 US every month to go into investment A and to go into investment B. So the amount that goes into both investments are the same. Both investments also give you annually the same returns, about 6% conservatively. Fees, that's where it differs. So for the first investment, you're paying anywhere from 0.2 to 0.8% of the assets under management annually. These are actually Stashaways fees. For investment B, you're paying anywhere from 2.5% every year, and then 1.5% annually. There's a management fee. Perhaps there's also different sort of hidden costs. As an example, every time perhaps you decide to deposit more cash in, you transfer more cash in, you're charged a transaction fee, there's an admin fee, there's a service fee, different kinds of maintenance fees, right? Now, what happens in 30 years? So for the lower fee, with the monthly contribution of 2,000 US per month, in 30 years, you'll get roughly about 1.8 million with an average growth of 6% annually. While for the investment with the higher fees, you will only get 1.2 million in 30 years. What this means is that you have not paid 600,000 in fees, don't worry. But what it means is that you've missed out on the compounding effect of your cash because of the excess fee that you have paid. 600,000 is a lot of money, right? But monetary fees are not the only thing that matter. There's also a lot of hidden costs when you're also trying to self-manage your own investments, right? So if were managing your portfolio yourself, there are a lot of other costs that you're paying for without realizing. First thing is obviously the time. You spend researching, monitoring, managing your funds, the emotional cost when you make mistakes. You may beat yourself up, you feel FOMO, you feel stress. There's also the opportunity costs, all the shoulda, coulda, wouldas. What about if you miss rebalancing your assets and you're taking on more risk than you're technically comfortable with? And more importantly, you could be potentially also you're underperforming, right? So this is why you should consider managed ETF portfolios, right? It's managed professionally to ensure steady, reliable performance with diversification with an asset allocation strategy. The diversification allows you broader market exposure to different sectors and asset classes according to economic cycles. Managed portfolios also help you ignore short-term market noise and emotional overreactions and helps you stay invested through all the volatility. Now that you have an understanding of what it means to invest, what are your options? How do we implement this into your general investing portfolio? And what are some of the best practices to ensure that you're able to grow your wealth successfully? Now, when it comes to your financial journey, building good financial habits is part of laying a strong foundation, much like a house. It's what keeps everything standing over time. Now, we often hear about beating the market or chasing the next big win, but here's the truth. Consistently smart habits are just as important, if not more so, than always trying to outpace a benchmark. Why? Because sustainable wealth isn't just about one-time home runs, right? It's about steady, repeatable steps that grow your money while keeping stress low. It's all about consistency. I think as we've learned through life, a lot of things don't just happen, because of a one-time effort. Sometimes it takes time and practice before you actually get to where you want to be. Now, obsessing over beating the S&P 500 might get you a quick thrill. Hey, I beat it today. But it's the daily choices like saving regularly, diversifying your asset mix, or sticking to a plan through ups and downs that build a future you can count on. Now, let's talk about some habits that can make your financial life not just richer, but calmer and more in your control. So the one habit that we strongly believe in here at Stashaway is the concept of dollar cost averaging, or DCA for short. Now, DCA is the act of investing regularly regardless of the asset's price. So you set a specific schedule that you're comfortable with, put aside a specific amount of money, and sit back and watch your investments grow. This helps you take the decision-making cognitive load off your investment and frees up time to really allow you to pursue other tasks. How does DCA actually work? Now, first, an investor decides to allocate a specific amount of money, typically on a regular basis, to purchase a particular asset. Now, the consistency entirely depends on your circumstance and comfort level. So it can be weekly, bi-weekly, monthly, every 2 months. It could be every quarter. But why is DCA so powerful? So as you can see in the chart, it smooths out the ride over the long run. When prices are high, you buy less. When they're low, you scoop up more. So automatically, it averages your cost over time, and no crystal ball needed. Second, it kills the temptation to panic or chase any sort of hot trends. So instead of stressing about beating the market, you're building wealth steadily, brick by brick. And studies also show that market rise long-term, DCA actually lets you ride the wave without sweating the dips. Now, dollar cost averaging is actually one of the core fundamentals for a long-term investment strategy. It encourages discipline. I know I use that word a lot, but it's actually really important. It removes the need of timing the market because ultimately it's time in the market that counts more than you timing the market, because obviously timing the market is challenging. And it turns investing into a habit you can actually stick with. I think for a lot of times, the main hurdle that a lot of people experience is, how do I actually stay consistent? How do I actually build this habit, right? And this actually also helps to make your investment journey less about luck and more about consistency. So let's say you've picked the assets that you want to invest in, and you have been consistently DCAing into this portfolio. What's next? Now, keeping them in line with your goals, especially when market gets wild, that's where discipline and rebalancing comes in. I spoke a little bit about discipline, rebalancing earlier on. Now, rebalancing is really about realigning the weightings of a portfolio of assets to maintain the desired level of your asset allocation as well as your risk. Now, let's use this next slide as an example, right? Picture your portfolio as a garden. So you plant it with a mix, right? 60% stocks, 40% bonds to match how much risk you're okay with and you're comfortable stomaching, right? But over time, things definitely grow unevenly, right? A stock boom might push you to 75% stocks, meaning the value of your stocks now has risen so much that it's 75% value of your portfolio. Unfortunately, bonds perhaps are not performing as fast, so it's only now making up 25% of your portfolio. This actually makes your portfolio or your garden, like right away, a lot riskier than you had originally planned. Because initially you had planned it to be, 60% stocks, 40% bonds. Now it's because, the stocks have overgrown a little bit, using that analogy. So now it's 75% stocks, 25% bonds. So rebalancing is like pruning your garden back to where it should be originally, right? Selling a little bit of what's overgrown and adding to what's lagging to get you back to your 60-40 mix. Now you might actually ask, why bother? It's good, right? My portfolio is going up and up and up and up. Not really. Rebalancing actually helps you keep your risk steady. So you're not accidentally betting more than what you can actually handle. And it also forces you to buy low and sell high naturally without guessing market moves. Now let's take 2020 as an example, right? Stocks crashed and then soared. Now rebalancing would have locked in gains and reloaded on bargains. Staying disciplined, honestly, it's not sexy, but it's smart. It's how you make sure your portfolio fits you and not the market's mood swings. So that definitely helps to keep your financial journey on track for the long haul. Okay, so you've got your DCA, you've got your whole dollar cost averaging thing down. You understand what rebalancing is. You know it's important. What's next? Okay, investing definitely feels like a roller coaster. I'm not even going to sugarcoat it. Ups, downs, plenty of noise telling you to jump off or double down, right? But here's the secret weapon, a long-term mindset. When you invest for the long term, your strategy where assets are held for an extended period with the expectation of realizing substantial gains over time despite short-term market fluctuation. So despite the volatility we see on a daily basis, when you actually zoom out, markets have a remarkable habit of trending upward over time. As I mentioned earlier on, statistically, markets have 100% recovered, right? We just don't know time. Think about it. Despite crashes, recessions, headlines, the S&P 500 has grown about, on average, 10% annually over decades. And again, just to repeat myself, statistically, despite all the market downturns, markets have 100% recovered most of the time. The caveat, the only thing we don't know is how long it takes for a market to recover, but it does recover. That's the most important thing. So that's why it's also incredibly important for you to stay invested. If you had invested $10,000 in the S&P 500, sorry, this is meant to be a moving chart, but it's not moving at this point in time. But the point that we wanted to show here is that if you had invested $10,000 in the S&P 500, you kept your money invested in the markets, even through the downturn of COVID-19 itself, you would have made about 650% in returns, right? That's if you've invested and stayed invested for 20 years, all without lifting a finger. So let's assume you decided, hey, today market is down, I want to exit. Tomorrow it looks like it's recovering, I want to go back in. So even if you miss 10 good days in the market, 10 good days over the course of 20 years, you would have lost out on 350% of potential returns. Again, this graph is meant to be moving to illustrate that. But the point that I'm trying to get through is that it's so important to stay invested because historically, much of the worst days and best days in markets have basically happened very close to each other, and it's very hard for an individual to predict. So the best thing you can do is just stay the course, stay invested, make sure you're investing within your risk parameters, the comfort level, the risk comfort level, and just stay the course, and try to block out as much noise as possible, and just make sure that you are investing for the long term and you have a long-term mindset when investing. Now, what does the magic of staying in the game actually do for you? First, it unlocks compound growth. That's very important. So your gains earn gains, and it snowballs your wealth the longer you stay invested, right? Second, it allows you, or rather, it helps you ride out the volatility. So dips like what happened in 2008, what happened in 2020 become blips when you're in it from the long haul. Just imagine 30 years from now, whatever happened in 2020, you'll be like, okay, I remember what happened, but I stayed invested and that paid off. Third, it's how you basically achieve your big goals, like retirement, when you stay invested for the long term. It could be retirement, it could be buying your dream home, but give your money time to grow. Best of all, it cuts emotional decisions. No panic selling or trend chasing, just steady progress. A long-term view ignores the daily drama. It lets you build wealth calmly and confidently. And it's not about outsmarting the market. Investing is not about outsmarting the market. It's about outlasting it. That's the most important thing. So it turns investing into a marathon that you're built to win. Now, the only way to learn is to do. So if you're thinking about starting, your ETF investing journey, there are two ways. You can choose to build it yourself via a brokerage platform, but if you want to do that, you can. But remember, I mentioned that there's a lot of hidden costs of self-management. Or you can invest via digital platforms. It's the 21st century. We are incredibly lucky to have mobile phones, to have things right in front of us. And if you want to invest via digital platforms like Stashaway, and if I were you, I would actually choose the digital platforms and just use technology to my advantage. Now, at platforms like Stashaway, we make investing simple. You can set and forget. It's cost effective, 0.2% to 0.8%, and intelligent, as we have an algorithm, our proprietary technology called ERA, running in the background, taking into account any sort of macroeconomic data to ensure that we're invested in the right sectors and assets at any given time without compromising on the risk tolerance of our clients. Now, that's very, very important, right? As I mentioned, depending on what the risk tolerance you're comfortable with, you decide, you pick it, and then based on that, that portfolio would sort of already have a curated portfolio of what are some of the assets that are suitable for this specific risk tolerance level. And that's very, very important because that helps you stay the course. That helps you invest for the long term. Now, that aside, actually, why are digital platforms the way to go, and why should you actually leverage technology to your advantage? First thing, investing used to mean big bucks, complex decisions, and a suit and tie investor, right? Used to sound really scary, but not anymore. Because using a digital platform to invest in managed portfolios is honestly hands down one of the smartest ways to grow your money. It's all about leveraging tech to your advantage, as I mentioned. And here's why it's a game changer, right? First, it's got a low barrier to entry. You can start with as little as $50 or $100. So it makes it accessible no matter your budget. Secondly, it offers automated portfolio management, automated rebalancing. I saw a question that did ask that does Stashaway actually do the rebalancing? We do. So because of that, you don't need to pick stocks or time the market. The platform does all the heavy lifting to you. Now, this is actually in a modern world, digital wealth platforms, majority of them would actually do it for you. Third, it's cost effective, right? Fees are way lower than traditional advisors because obviously it's mobile first. So more of your money actually stays invested, which is important. If you remember the example I showed earlier on, the difference between paying higher fees and lower fees is pretty significant. But I do want to obviously caveat that it doesn't mean that you paid so much fees. It just means that, hey, whatever fees that you potentially have paid in excess could actually have been invested to, further give you more gains in your portfolio. Second, but last but not least, actually, it's globally diversified, most of the portfolios. So you spread your cash across markets worldwide to cushion any sort of up and down. And with advanced risk management, there's built-in algorithms, or rather, platforms would have their proprietary algorithms like Stashaway called ERA, to keep your portfolio aligned within your comfort zone. So there's no guesswork required, right? So it isn't just investing, it's actually tech putting your financial future on autopilot, which is something that you want to do. So it helps you build wealth simply, affordably, and comfortably. And it's your chance to harness innovation for a win that actually lasts, right? Because what we want to do is we want you to be able to enjoy your life, be able to have that dinner with your family, be able to watch that movie with your spouse, maybe, and let us do the work in the background. Now that we've run through core principles, what are the action points for you? So the first thing, determine your risk tolerance and investment goals. how much risk are you willing to stomach? How much, what is your breaking point, right? What is your break point? What is the amount of volatility that you're willing to actually stomach or you're comfortable stomaching? And what are your investment goals? It could be 6 months, it could be 1 month, it could be 1 year, it could be 10 years. It's entirely up to you. Everybody's circumstance and capacity is different. Second thing is obviously diversify your investment strategy across the different asset classes. The four main asset classes we talked about, let me just repeat them. They're equities or stocks, bonds, commodities, as well as, it's also important for you to have a small cash holding, just for rebalancing purposes if need to. Third thing that a lot of people often do not pay attention to is fees. Very, very important. Ensure you take into account the fees that you're paying. If you're having a conversation with, a financial advisor or whoever tomorrow, or even if you're onboarding on a platform, make sure to ask as much questions as possible about fees so that you can make an informed decision about the investment that you're going to be undertaking. The fourth thing, keep good habits, stay disciplined. So DCA, rebalance your portfolios. And last but not least, obviously maintain a long-term mindset, stay the course through the noise. I get a lot of questions of people asking, "Hey May, when is the best time for me to actually invest?" And I don't have a crystal ball, but what I can say was the best time was yesterday. The second best time is today. So that ties into our last point, which is start investing. If you have not started, just open that account, look for a provider that you're comfortable with. Just get over the hurdle of putting in your first 100, your first 1,000. If you're already invested and you are a little bit wary, given obviously the last couple of days, markets have not also been fun. It's been unfortunately a sea of red. Just remember why you're investing, right? What your goal is, and just stay the course. If anything, find time to sit down and really understand what's going on. Understand if you're feeling a little bit uncomfortable, maybe it's because you're taking a little bit too much risk. It might be a good time for you to kind of sit down and rethink whether or not you're currently invested in the right portfolio for yourself. Now, to sweeten this and to help hopefully everyone get started, even if you're already an existing client, we are offering to manage your next deposit of up to $50,000 for free for 3 months. So the code is actually, if you're an existing client, you can just actually scan this. It should lead you to the platform. If you're a new client, you can just onboard with us first, and then you can type in this code later on. And what it means is essentially for your next deposit of $50,000, it will be managed for free. This does not mean that you must put in a $50,000 to be eligible for this. It can be cumulative, so you can start with 1,000 and then set up your DCA. And it can also be cumulative. Yep, so that is actually all for today's core principles of investing. I hope I've been able to share some information with you. If anything, I hope I've been able to also help you understand a little bit more about some core principles of investing and what is important when it comes to investing. So for now, I do see some questions. I will start answering questions again. If you have any, sort of questions that you want answered about Stashaway, about the presentation, if there's something you'd like for me to repeat, just let me know. So let me start with the first question that we have here in Zoom. Again, if those on YouTube, feel free to use the YouTube chat box. If you're on Zoom, feel free to use the Q&A option. So the first question from anonymous attendee, what's your current view of the US, China, Singapore markets in this tariff war? Now, obviously, I can't, this is not financial advice. The tariff has definitely created some jitters across global markets, and the reality is people do not like uncertainty. The reality is, I think, we will continue to see some volatility over the next couple of months, especially as world leaders come out to talk to Trump. My view is, as I mentioned, markets have always recovered. So I would say just stay the course. If you already have a portfolio, decide if, when you're comfortable to potentially put in more money. If you have a cash pile, put some money into buying some of the assets cheap. I think the reality is we don't really know what's going to happen. And I think as history has shown, no one really wins in a trade war. It is what it is. It is a trade war. And it really, we're not too sure how this will play out, but I think the reality is from a market and investing perspective, if you already have an existing portfolio, it could be a good time for you to DCA. If you are currently caught and you're feeling a little bit uncomfortable, it might be a good time for you to review how you feel and whether or not you're actually investing within your risk comfort level. I can't give any predictions, but my current view is, again, not financial advice, that the volatility will actually happen and will actually, there will still be volatility in the next couple of months. But just be smart about the assets that you want to pick and you want to invest in. If you're already invested, it could be a good opportunity to dollar cost average. If you're feeling a little bit uncomfortable with what you're seeing on your portfolios, then maybe you would need to relook at the assets that you're investing in. If you're new to investing, it might be a good time for you to buy cheap. So that's all I can say about the current happenings in the news. Okay, in the current volatile environment, is DCA weekly or DCA monthly better? There is no black and white. There is no one size fits all. It's a one size fits one. You can opt to say, for example, if you have $1,000, you can say that, hey, I want to DCA 200 every week and see what happens. I would do that versus putting in 1,000 in one go, because you can't actually predict how the market will go. But it also depends on your capacity. If you have the capacity to set up a DCA weekly, do that. If you only have the capacity to fund your account once a month, then you can do that. For me personally, I'll just share what I do. I DCA every 2 weeks. So regardless of whether the market is down or market is up, I actually deposit money into my portfolios, just because I know that I'm investing for the long term. I know I wouldn't need these funds for the next 20, 30 years, hopefully. So I am not unbothered, but I'm indifferent on when I actually buy the assets. For me, the most important thing is that I actually spend time in the market. And because of my capacity and because of my comfort level, I'm able to DCA every 2 weeks. So my DCA is set up for every 2 weeks, regardless of market conditions. But to answer your question, in the current volatile environment, is DCA weekly or DCA monthly better? If, as I mentioned, we're unable to predict where markets will be in the next couple of weeks. If you think that, hey, if I buy today and there's a potential for markets to still remain uncertain and volatile, and I'm okay with that, then, by all means, set up a weekly DCA, because that means you have to constantly buy. But if you feel like, okay, I want to wait and see, and I know I'm probably not too comfortable putting more money in the current market environment, then set it up for monthly. But ultimately, just make sure that it's within your capacity and it's within your risk tolerance. Yeah. And as I mentioned, it's not one size fits all. It's really one size fits one. Okay. What's Stashaway's current strategies or actions to mitigate the tariff risks and safeguard investors' portfolio? So currently our portfolios are invested based on the algorithm, our ERA algorithm. And the last time we actually re-optimized our portfolios was, I think it was a year and a half ago, if I'm not mistaken. Currently, our CIO has also reassured us that, our portfolios are actually are structured such that we are actually optimized to be protected against any sort of headwind. We will see volatility, especially if you're in the higher risk, because you would have higher exposure to equities. But at the same time, all our portfolios have exposure to different assets, including bonds, and including commodities. So even if equities were to experience a massive downturn tomorrow, the presence of bonds as well as other assets in your portfolio would help to manage that volatility and would help to actually hedge the downturn or the drop that your portfolio experience from equities. So that's actually how we strategize our portfolios to be, just to make sure that all our investors' portfolios are safeguarded against any sort of headwinds. If ERA, which is our proprietary algorithm, in the event ERA does tell us, hey, based on what is projected to happen perhaps in the next couple of months, perhaps in the next 6-12 months, based on whatever is said whatever is said by the Fed, based whatever the macroeconomic data are showing us, we should perhaps get out of specific assets or specific sectors, and we should maybe take a more defensive, or we should invest a little bit more into bonds, as an example. That's when we will actually re-optimize our portfolios. All our investors will know, and then that's when the assets in the portfolios will change. But for now, given the how diversified our portfolios are, I think we don't have to worry. But obviously, as I mentioned, no one knows how the market would move. What I would suggest is that relook at your portfolio. If currently, say for example, you're invested in a slightly higher risk portfolio, you're a little bit uncomfortable, then maybe it's worthwhile actually relooking and understanding whether or not this is your actual risk tolerance. Maybe you want to take lower risk, but at the same time, you just understand that by actually switching your portfolios, you will be realizing any sort of, I guess, losses because you're selling the assets, or realizing any gains because, again, you are selling the assets. So I would be careful with that. But I just want to reassure you that given how diversified our portfolios are, the global market exposure, the exposure to the different assets, that's our strategy to ensure that we're actually safeguarding your portfolio in the current turbulent times. So I just want to reassure you that, we are doing our best, and our investment team is constantly watching the market just to ensure that we are not taking outsized risks, and that we are investing within the risk parameters of what our clients have chosen based on the portfolios that they are invested in. Okay. Hamer has a question. One portfolio with large sums or many small portfolios? Again, I do want to share that it's not one size fits all, it's one size fits one. If you have, a large amount of cash, then you potentially have the capacity to split it into different portfolios of different risks so that you're able to get different exposures. But if you only have a small sum, then perhaps it might be worthwhile deciding on just one portfolio that you're comfortable with. But generally, I would suggest many portfolios and then DCA into each portfolio be just as a diversification point, because I think it's incredibly important for you to be diversified even within the different portfolios itself. So it really depends on your risk tolerance and your risk capacity. If you're willing to take, an outsized risk, as an example, then, go for it. Just put it in one portfolio. But if you feel like I want to diversify a little bit more, then put it in different portfolios. So I can share my own experience. For me personally, I have a lot of different portfolios because I just like to diversify across different assets and different risks, just so that I know that I'm not caught in the event, say for example, if let's say, was it 2022 or 2023 when both risks and bonds was actually down double digits, which was very, very rare, because usually if equities is down, bonds are up and vice versa, right? But at least, I know when I'm diversified, if I know that I need a sum of money by a certain period, or in the event I need some money, potentially my low risk portfolio, I'm ready and I'm happy to realize the gains in that portfolio and take the cash out for whatever I need to use that cash for, versus potentially my high risk portfolio where I could be realizing losses at that point in time. So it really depends on you, but generally for me, I'm happy with having multiple portfolios. I think the more important thing is that you actually consistently DCA, and it's not like a one-time deposit. Actually setting up a consistent DCA to multiple portfolios, that's when you're actually able to take advantage of the market as much as possible. In terms of asset allocation. Okay. So it's a continuation of your first question, which is what stash away strategies or actions to mitigate the tariff risk? So in terms of asset allocation, as I mentioned, we have a very diversified, regardless of I'm assuming you're invested in our general investing portfolio. If you're invested in general investing portfolio, each portfolio already has a very diversified mix of assets. So there's equities, there's bonds, and there is commodities, as well as a little bit of cash just for rebalancing purposes. So all the assets currently are still the right asset mix based on the ERA algorithm. and based on what our investment team sort of foresees it to be. In the event that the algorithm tells us, hey, there are specific assets that are perhaps not irrelevant, but have basically, done their time, we should actually swap out and look into perhaps assets that are a little bit safer, assets that are a little bit more defensive in the upcoming volatility. Then we will actually re-optimize the portfolio to swap out the assets that require the swapping out, like a better way to describe it. So we are constantly watching. Right now, the asset mix in our portfolios are still okay, and still can stomach whatever volatility that's coming. That said, it could change in the next couple of weeks. I can't predict. But ultimately, I do want to assure you, John, that in terms of asset allocation, our investment team is consistently watching. For now, whatever assets that are currently in the portfolio, sorry, excuse me, are still of the right mix. For you as an investor, just recheck that you're invested in the right risks, that you're invested in, portfolios that suit your own risk comfort level. But if there's a very specific question related to your own portfolio, I would suggest you actually reach out to our team at support@stashaway.com. We'll be able to help you on a more personal level. Because all I can say right now, to give a very, very general point of view, that is not, portfolio specific, is that the assets that are currently in our portfolios are still going okay. ERA has not given us any sort of adverse indication that we have to do any sort of re-optimization, that there's anything that we should basically prepare for at this point in time. Yeah, but if there's a very specific question related to your own portfolio, we'd be happy to answer it. Just reach out to us at support@stashaway.com and our team will help you in any way that they can. So yeah. All right. Let me just give another maybe 10 seconds. We're approaching 8 p.m. I also do not want to hold people back from, getting dinner. Again, so if you have any questions, we are available at support@stashaway.com. If you want to start investing or you've already investor, the promo code you see on your screen, feel free to use it, type it into the app, or if you're currently already an investor, scan this. We do have more Master Your Finances series coming up in the next few weeks. So please sign up for that. Stay tuned for the emails. Next week, actually, I'll be diving a little bit deeper into ETFs. So if that interests you, please do sign up for that webinar. I hope that I was able to share a little bit more of the importance of staying invested and some of the core principles of investing with you today. I see that we don't have any more questions. So yeah, we can just end it early. Again, if you have any questions, feel free to reach out to us at support@stashaway.com, especially if you have questions pertaining to perhaps your own personal portfolio. I think it's better for us to answer that in a more private setting, also understanding your circumstance. Or if, you're like one of our audience member here who has very specific questions about maybe specific asset allocation. Right now, I can only answer generally, but I would love to, we would love to have that conversation with you to really understand what are your specific questions and how we can actually help you understand Stashaway portfolios a little bit more. So yeah, with that, I will end it today. Once again, thank you so much for watching, and I'll see you guys next week. Thank you so much. Good night.